This week on Sylvia's Traders Lounge.
Like I said, I didn't start with screens or trying to be an algorithmic trader, a technical trader, looking for patterns. It was more the actual market structure that I'm trading. And I'll go through some of that today.
Sylvia's Traders Lounge welcomes you all to yet another webinar where we learn trade and profit. We shall be giving you trading insights on technical analysis, fundamental analysis, risk management, and trading psychology. Today's guest is Brynne Kelly, and our theme is Basic Fundamentals of Trading Oil, Brent and WTI with Brynne Kelly. Brynne Kelly is the founder of The Fundamental Angle, an analysis and consulting company that leverages her 25 plus years in the energy industry. She has served in leadership roles on merchant trading desks for some of the world's leading energy conglomerates, managing large portfolios ranging from 100 million to over $1 billion US. In addition, she has managed portfolios for large hedge funds and unregulated subsidiaries of large electric utilities and designed software applications for a leading ETRM software provider. She is passionate about understanding markets, what influences them, and her background makes her a natural fundamental trader due to her deep-seated experience in the merchant energy business. Welcome, Brynne. It's nice to have you third time on our trading lounge.
Wow, 3 times already.
Yeah, and
you guys have been around.
And thank you so much. And because, guys, we've interviewed Brynne a couple of times before, I think you can just tell us a brief history into your trading, and guys can refer back to our previous webinars before we dive right into the questions for maybe new participants who are joining us for the first time.
Sure. I mean, I'm not going to go into like you said, the whole sordid history, but I started my trading career a little bit later in life. I'd had a couple roles prior to that, working my way into the trading business. So I was probably 5 years out of college when I finally got my first trading role. And my trading experience has been primarily in merchant energy trading shops. And what that means is that the style of trading is very fundamental. You are leveraging your ability to move product around the country and take advantage of, dislocations in the market, and really utilize your ability to store a product or blend a product or move it from one part of the country to another because you own some pipeline space. And so there was a lot of relative value training that I got very early on in life, in my career. And I think that's why I lean towards being a fundamental trader. And in fact, when I started trading electricity in the late 90s, when electricity was being deregulated in the US markets, there wasn't even a futures contract. So it was all traded over the counter. So there wouldn't have even been really technicals to have unless you created them yourself. There was no posted closing price. There wasn't any exchange that anything was trading on. And so you were going definitely by fundamentals to form your view, and brokers would call you and you'd give you the markets and whatnot. And some markets are still like that today, but so many things are on the screen. And it seems like that's kind of led a bunch of people into trading the screen, which is a different style. When you're trading the screen, you are looking at, screen indicators, right? Moving averages and signals like that. And I don't really use that in my trading because I'm not in and out, every 5 minutes. I'm developing a point of view, and then I am putting a position on related to that. I define when I might get out, and I'll hold it until it, reaches the target. So I'm not trying to pick the exact tick time to get in. I'm just saying this is either too expensive or too cheap. And that's how I'm going to put my position on. So I think there really are, kind of two forces in the market. I pay attention to a lot of some of the technicals just because it's interesting, but I don't really use that in my overall trading. A lot of times because when you're working for like a large energy company, your positioning is so big that there's no way you would put it on without moving the market. So, you're not in it for a 5-cent move or a quick, bounce off the low or something like that, right? You are trying to layer into a really large position. And so that's where I come from when I talk about fundamentals and how I look at the market. It doesn't mean that it's just one look at a different style, I think. And I hope that's what I can share with people is just how other people come at the market that may not have, like I said, I didn't start with screens or trying to be an algorithmic trader, a technical trader, looking for patterns. It was more the actual market structure that I'm trading. And I'll go through some of that today later when we get to that. So.
All right. And I know you're a big energy and natural gas trader, but because our focus for today will be on oil, maybe you can briefly tell us what some terms, they might seem like jargon to us, like backwardation, what that means, and for oil traders, how they can make use of that.
So when we're talking about backwardation and contango, and I know words are always out there. I'm very visual, so I like to see what that looks like. And so this chart, and I hope everybody can see it, that we have on the screen.
Can everyone see it?
Yeah.
Can? Okay. So these are what are called futures curves. And is that a term you're familiar with, the futures curve?
Yes.
Okay, so essentially, this is a line of, this is the July contract, August, September, October, right? So this line depicts the settlement price of each of the future months in the WTI complex. And I like to always see, the shift in the curve. And in this particular chart, it starts at January 2017, which is the blue line. And then we just go to 2018, this cyan colored line, and then 2019, 20, and now where we are currently. And so when we think about backwardation or contango, this was as of last night's settle, right? So, I guess that's a couple days ago. You can see this is a backward structure. When the future prices are lower and lower and lower, you can see that this is a 3-year futures curve. So going out 3 years, the market is in backwardation, which is different than, so let's look at the beginning of 2019, which is the red line. That's contango, right? So every month in the future is more expensive. And it's really, very basic. Either it's negative sloping or positive sloping, and it's just how steep the slope is. And that's really important. And that's what a lot of people trade is, you can see this structure as it was here, right? It was kind of in contango and then went flat. Once OPEC a couple years ago did their first initial cuts, really the curve started lifting and moving into backwardation. And that's because, and even with the OPEC cuts now, now that we've gotten rid of the supply or the, glut that we had out there, we're withholding more now than we will be in the future. And so you can picture more and more crude oil comes online. That is why the front is bid up more than the back of the curve is. And people are just trying to gauge, will we have a demand recovery before we bring all the supply back on? And so the shape and the steepness of this curve is shifting based on people's expectations of where that pain point will be. Does that make sense?
Sure, it does. And a few months back, I think it was in March or April, there was a ship that got stuck at the Suez Canal.
Sure.
So that caused a high demand for the oil market. So how does that or such an occurrence affect oil traders?
So what was really interesting about that is an initial reaction to, a fairly big news, such as a blockage in the Suez Canal, or, we had the drone strike in Saudi Arabia, is for the market to rally. And just, that's it, flat price goes up. But then when people started looking under the hood, the real pain point on that blockage would have been the spread between Brent and Dubai. Because you suddenly cannot get back, in through the canal and to those markets. And that spread never blew out. And if that spread is not in trouble overall, then, and in a way, I think we had a rally and then it really came back off because, unless you have a locational spread that is demonstrating the issue, the crude oil is there. It was just, all taking a little bit longer to get to where it needed to go. I think if it had gone on longer, maybe we would have seen an issue, but, people had healthy inventories. And at the time, it just, it was an interesting headline. And then fundamentally, there was nothing that supported it. It was much more of an issue for physical goods and container ships. There aren't that many ships that go through. I mean, there are, but there's a lot more that go through the Suez Canal on, just think about manufactured products, food and things that you bring in containers. So there was an issue, but there was no validation in the location spreads. And for me, that's why, you had to sell the rally.
Cool. Thank you for that, Kelly. And when it comes to trading oil and basically energies, is it important for traders to pay attention to seasonality or seasonal tendencies? And if you don't mind, would you elaborate on the aspect of seasonality when it comes to trading energies and maybe other commodities too?
Sure. Seasonal trades are a really big deal in energy markets and in commodity markets in general, right? There are different services that even, kind of run all the data, and they will put out like, if you buy June and sell December, that spread on this day and get out of it on this day, 11 times out of 12 or 39 times out of 40, it makes money, right? And that's because naturally a lot of commodities do have seasonal cycles where regardless of the overall tenor of the market, even if the tone of the market is really bearish or really bullish, the seasonal moves still tend to happen. And this next chart here, sort of gives you an idea of these seasonal patterns. So this is for WTI crude oil. And this is looking just at month one, the continuous rolling futures. The red line is the 10-year average. And the black line is the 5-year average, excluding 2020, just, that doesn't, it's an outlier, right? But you can see that, there is a general pattern, the first, up through May where the market kind of goes up. And in that way, there are people who they're not trying to pick. They just know that, like, if you buy, it looks like February something, February 3rd or 4th, and maybe you exit the trade. Maybe they say April or May, right? Regardless of the path it takes there, it tends to be a good seasonal trade, wherever the level is coming from, right? Because you can see here we were below $50, and here it was 70. But in both cases, we moved up, and that would have worked, of course, this year too, right? If whatever, right around February here, and if you look at where we are now, this green line, right, is current 2021. We kind of had that same seasonal shape. to it. And it's less pronounced the second half of the year, but you can see sort of in general, we trend lower, from now until the end of the year. And you can see these shapes in a lot of markets. Like if we look at this next chart is the spread between gasoline and heating oil. So RBOB, so RBHO, right? A lot of times it's in this market, it's called the Widowmaker, even though every market has their Widowmaker. But again, we have the 10-year average of this spread relationship. And it's important, the relationship between, because nobody uses crude oil, right? You use heating oil or jet fuel or diesel or gasoline. And so the relationship between those two prices has some really good signals in it. And yet, if you can see, so the dark blue line is the 10-year average. The lighter blue, medium blue line is the 5-year. And then we have the light blue line, which is current. And again, you can, even though we might be at an elevated level here, you can see that we follow the same sort of seasonal patterns. And it's sometimes when the market is trading during the day or during, any particular time when it deviates too far from this, that can be either a piece of information that, there's something fundamentally really driving that, or it can be, look, there are a lot of different ways that people trade energies. There are some people that link it to foreign exchange. There's some people that link it, to bond yields. There's some people that trade flow business from customers. And in that way, some of these forces and this flow that comes in the markets can dislocate one of these relationships during the day or during a period of time. And in that way, if you kind of have this underlying sense of how these relationships should look and how that merchant traders will react to it, right? Because if there is a dislocation, it's like in financial markets, if you have one company buys another and the buyout price is $50. And, the company that's being bought, the price kind of immediately goes to $50 because if it doesn't, there's an arbitrage there. And so that gets arbed out, but for the fear of, it not happening, right? The arbitrage will get taken out of the market. The same thing happens in energy. It just takes a little bit longer because you can't just hit a button, right? You got to physically move a product from one place to another. And just kind of knowing that, you can watch some of these spreads and if you see, them getting too wide, you would expect people to come in and react to that. So I like to look at a lot of these different relationships, and they all have their sort of seasonality. And you can look at them yourself. You can subscribe to services, right, that calculate that for you. But in that way, seasonals are not really so much about price levels. They're just about timing.
Okay. For the sake of guys who are new and they're joining us for the first time and they're hearing about you for the first time, and most of the guys who come into trading, especially in this part of the world, they first of all come into trading through the currency markets. How important will it be for them to track the energy market in order for them to have, to take basically speculative positions on currencies? What is that, correlation that they need to know and understand?
So I think the currency to oil relationship, in my experience, has been, it's a macro relationship. So, macro patterns are hard to trade because they can take years to correct. I've noticed sometimes intraday or in a week, if the US dollar is lower, oil, might move up a little bit. The theory is that if the US dollar is high, it costs other countries more to buy oil, right? Because they have to buy US dollars, and vice versa, right? If the dollar is low, but it's not a very strong relationship. Maybe in the back of the curve, right? If you're like, I notice like they might buy calendar 22 or 20, way further out on the curve, that might react a little bit more to currency fluctuations. I think, I don't know. I don't know how trading oil would help you in currencies. I think currencies would help you a little in oil, but you'd have to have a pretty tight sort of algorithm or, macro that is, I haven't really seen intraday where, that's a fair tradable relationship. They both, you can have there's so many fundamental drivers in oil, right? You could have a pipeline explosion. You could have like the Suez Canal, you can have a hurricane, hot weather, cold weather, that just has nothing to do with the currency. And in that way, there's, if you kind of gotten yourself framed into some relationship, and then you have one of these fundamental factors that comes in, and the same thing can happen in currencies, right? You can have a change in interest rate or policy in a country, and those things just don't coincide timing wise. But that's, if, maybe other people have found a better pattern. I don't know. It's not one I'm not. I'd rather trade crude oil versus like WTI versus Brent, right? Or, WTI versus gasoline, or US gasoline versus Europe gasoline, like kind of stay in the family, right? You trade the things against each other. I don't even have enough time for all that. And then to try to add in currencies. I mean, I got enough instruments. How about that? There's enough products out there that are more correlated to oil that I don't think that, for me, I don't, there in currencies, that's probably pretty deep too, right? You got a lot of things you have to look at. So,
and in terms of, can the energy markets also be used by traders to gauge overall market sentiment, for instance? Have you seen any correlation between market sentiment and moves in the energy markets?
I think at extremes, there definitely are. So when oil was, crashing, and not even so much this time, but in like 2014 and 15, the markets are kind of crashing as well, right? And the theory being that energy is has a pervasive, application across all businesses, and energy companies were such a big part of the stock market that when energy was falling, it was dragging the stock market down. On the flip side, when oil and energy prices are really high, the stock market tends to initially go up because those oil companies are going up, but eventually it starts to be an inverse correlation. So I think was it 2007 and 8, when oil was above $100 and it was moving up, it was an absolute inverse correlation with the markets every day, right? If oil was going up, that was bad for the markets because everybody's input cost was going to go down. Things have changed a lot now with technology, right? We're not maybe as energy intensive, or people don't perceive that we're as energy intensive. And so it's kind of in the middle between $50 and $70. We don't tend to correlate that tightly with markets. I mean, equity markets have moved up so much. So is oil, but oil started from zero basically last year, right? So I think at pain points, right? And that's what we need to watch out for here, because now we're above $70 and, gasoline prices are becoming a problem, right? They're, an issue across the world, raising that. It's been a very nice subsidy the last several years with cheap energy, cheap oil, low oil prices. And I don't, I either, we'll have to see if we lose some demand up here at these levels. I mean, I don't know, what are you guys seeing over there? As gas prices move up, is there consumption? At what price do you guys tend to carpool or, take mass transit or not? Maybe it's not an issue. I'm not trying to be naive, but I don't know is there a pain point?
Not really.
There was a
I mean, I
slight
know, like, I
spike.
read a lot of stuff, from India, right? And it's, there's a lot of rural areas where, it's not affordable. And it really becomes a governmental issue, right? That people can't, tolerate these, increases at the pump. And so I don't know, to fill their car, right?
It's quite an issue, especially here. It was an issue, I think, 3 months ago.
Yeah.
When normally when there's usually a hike in the price of oil, but the authorities who regulate prices, and most people don't understand the connection between the global markets when it comes to the prices of oil and how that might have an impact locally.
Exactly. And all of a sudden prices are going up, right? And people think there's, it's like a government.
The government is after them. Yeah.
And I mean, I know here, people, look, everything, like, we have all of this delivery service, right? Amazon and all of this, logistics, moving everything around, and, in an environment in the last 5 years of pretty cheap prices. So, I think at some point here, it will be a pain point on markets, right? It will affect other companies' bottom lines, even chemical companies, that anybody that's using oil as an input, I mean, makeup, right? All of the input costs are plastics, everything. There's a point where it's a burden on the overall system. It doesn't seem that we're, it's been a while since we've reached that, but either prices are, we're so bullish they're going to, blow through, or we're going to start to see demand back off, right? Because people don't want to pay this much, just like lumber prices have been going up. And as a result, builders have just been pouring their foundation, but not building, because they're waiting for, everybody's waiting for the prices to come off, right? And if you look at this curve here, and let's say you are some sort of manufacturer, or, something where you've got to buy, people are kind of like, okay, I would just wait a few months, it's $5 cheaper. And in that way, if we keep moving prices up as it comes to delivery, at some point they can't wait anymore. And so I think, we're kind of at that precipice as things are opening, and there's a question of whether, like, how is this system going to handle all of these higher prices? Is that, I might have gotten off track there. I don't know if I stayed on your question.
Right. Yeah, I think in the interest of time, we're ready to learn from your presentation on like a live chart analysis, for instance, of how you trade oil, Brent and WTI.
Okay, yeah, so I don't have any live charts. I tend to make my own static ones, right? So just because I don't copy, I don't know who, what's you can share and that stuff. So so we talked earlier, I was showing you the spread. I was talking about spreads, and maybe we'll start off there. For me and for a lot of traders, the flat price, just trading the actual price, right, going long or short, you know, you can have dollar swings during the day. And if, you know, you're not babysitting it all day long, that's not really a place to employ a lot of capital, right? Because your risk is too high, right? If you have to, you know, employ, you know, $500 million, right? You're not just going to go all long something or all short. So most of what happens is that people are trading the structure of the curve, because you can put a lot of money into the spread between July and August, let's say. And so this chart right here, and this is a shift over time, but each dot, so this first dot is the spread between July and August WTI. And right now, the yellow line is where it settled yesterday. So that's around 20 cents. And then the next dot is the spread between August and September. And the next spread is September, October. So it's in a sense quantifying this shape, right? These are the individual months. And this is the difference between each month. And why this is important is you can see where this backwardation is the highest. So it's month 1, 2, 3, 4, and 5. So that's like August, September, October, and November. So if you were to look at, and I guess I could open that one thing. Let's see. What this is showing is, and I'm just going to pull up a live thing, and we'll go to that in a second. So over the last 10 days, right? At one point, this spread was 40 cents. Now we're up above 60 cents, right? So these are the trades, right? People are either buying the spread and then selling it up here, selling it here, buying it down here, because there's a lot of volatility in these spreads, but it's tighter and it's more manageable, right? And this is a good place to really get started in the oil markets. And what a lot of people use, and is this visible?
Yeah.
Yeah.
So this is what's called a spread matrix, and this is actually live in the markets, right? So this is showing each July, August, September, October, November, right? You can see the months going down and up across, right? So here's July versus August. So the market's 22 at 23. And we saw that right here, there's that July, August, it's 20 cents right there on that chart. So these are a lot of the key relationships that oil market players are looking at, right? They're just going across this curve. They might trade July versus DEES. A big one is December. It's called DEES, December versus December. And we're going to look at a chart of that. And so having access to these, you know, spreads, and then you can chart your spreads, right? And you can trade directly the spread. And that's, in that way, it doesn't matter what the price is, right? There are days when the spread can move up, even when prices are going down. A lot of times the price will move, you know, swing $2 and you won't see much of a move in this spread at all. But what tends to happen over time, so here is a line chart of each one of those spreads up until expiration. And you can see we've been selling off into expiration. So this spread that we had just looked at, right? Like July, August is right there. That's this one right here on this chart. But you can see all the spreads leading up to that have sold off, and they have not been able to hold on to their backwardation. So below this zero line, that means the front month settled below the second month. So it's settled in contango. So there's a lot of people in the market that are, you know, they just sell these front spreads and just carry them into expiration, right? And they just ride them down and they cover them. And are you guys familiar with the roll dynamic in the market, the fund roll?
No.
So it's a huge play in the market. So every month, most of the funds, so we'll talk about the Global Goldman Fund, the USO, all the ETFs, they roll from the front contract to the next contract from the 5th to the 9th business day of every month. So I think, so now for this month, right, that will be, let's see, 1, 2, 3, 4. So next week, right, we'll be starting those 4 days. And what's important about that is, so here, this chart on the left, this is the open interest of each contract. So for so the first line is January's open interest. And the reason I show the history is you can see the pattern, right? They peak, then the roll period starts the 5th through the 9th. And but by then everybody's out. No, the funds, when people are going into the market, for example, and buying US after the 9th business day, they're buying the next month contract, not the front month, right? So you have to know what your ETF, which contract it's in. And this month, I don't know if it might be hard to see this lime green line. This is the July open interest for the July contract. We can see it's peaked at a higher level than any other contract this year. And we haven't hit, the roll period yet. So in the roll, the fund has to sell the 1 month and buy the next. So they'll sell July and they'll buy August, or sell July and buy September. Right now, it looks like they're buying September. That's the pink line. But in that way, that collapses the spread. And everybody knows it. And everybody knows the funds are going to come in. I mean, they publish their roll dates, right? So you can see, so here's the open interest, right? On the left. And on the right is the price performance of the spread, right? From the first, the roll, from the 1 month to the next month. And, once the fund comes in and starts rolling it, there's all this pressure that pushes it down. So something to watch out for. It's not a perfect relationship. It's been the relationship this year, and kind of the end of last year. So A, it's a trade that works until it doesn't, right? And B, when it stops working, there's probably been a shift. If suddenly we're going to be explosive to the upside, if one of these is going to go strong into expiration, that's a real strong signal in the market. Right now, as we go into expiration every month and we keep expiring week, it's hard to sustain a rally then in physical and just outright prices, because you don't have confirmation of it here. So this is, really something to watch out for. And like I said, this is, if you're looking to get into oil, these spreads are where there, right? And you can, the green is, where they're, lifting the offer, buying, they're very active. It's an easy way to kind of test, a theory on something versus just trying to look at like a candlestick, right? And, in this way, you see the 23 cents is that spread, then it's higher, 47, then 61, 63, 62. And that's exactly what we see on this shape here, right? It was lower, higher, higher. And these spreads settled on their highs last night. So most people are kind of looking at selling them, right? So selling these spreads right here and waiting for the next pullback. Because you need something pretty significant to have that front contract priced so much over the second contract. And then if we even take that, or let me stop. Is there any question on?
No, not really.
Am I using language? Okay.
There is a gentleman is asking Ochieng whether you're a data scientist.
Data scientist? Well, not by education, but I certainly it's what every morning, it's how I know to trade, right? I get up, I get all the data, I pull it. I even learned to program in Python a little bit, and I'm not a
Okay.
programmer, right? But
Yeah.
in that way, you know, I like to look at information a certain way, and I was tired of looking at it in Excel. So this, I just, you know, now I can grab the data and manipulate it and work with it a little bit more. I have a little bit more control over it. And on top of it, it's free. So you can, if you know how to code in Python, and you can go to quandl.com, and they have all the APIs for you to pull all the time series data in. And have you guys used Quandl?
Yeah.
So you know that you can get, they actually have a lot of the crack spread futures and the differentials between, you know, different contracts. And anyway, so here is, and again, the theme is going to be calendar spreads. And a really popular calendar spread is called the DEES. I mean, it's December, right? But it's like DEES, red DEES, right? So the current December contract versus the 12-month out, that hence the red, DEES, red DEES. And in that way, producers use this to hedge. They'll sell this December versus the deferred one. It's used a lot for gauging the sentiment, the bull bear sentiment in the market overall, instead of buying just, again, the outright contract. People are watching these relationships. So each line represents a prior year, you know, kind of the walk that prices took, and then the dot is the expiration. So you can see, right, we get a lot of volatility in this spread. It moves into this $5 range. This is in 2014, but again, settled at flat or right under it. You know, the next few years, remember when the market, it was in contango, right? So you can see that here because the spread is settling below zero. And now we've kind of moved up, and the green is where we are today. You know, so if you were looking at that, I mean, I suppose you guys probably do a lot more chart, you know, analysis than I do. If you just outright were looking at this, right, you probably wouldn't buy it. Would you? I don't know. Tell me from your chart. So if this is where the spread is right now, this green dot.
It's too high.
It's too high.
Too high, right? I mean, it's, of course, we can say all the reasons why, right? We can make why it can keep going higher, oil's going to, but in general, right? It's like,
yeah.
So it's why you probably noticed the last week or so, volume has kind of not been that much, and the market is just, we're higher, but we're kind of stalled a little bit, and we're stalled everywhere, right? You can see that. I mean, you can't, it's hard to get people to come in and take this next, you know, leg higher, because we need an event for that to happen. You know, like this spike right here in the spread, that was the Saudi drone strike, right? So you get a quick spike, but then it comes back down, you know? So, you know, risk reward wise, you'd rather be short that spread, you know. Of course, it could go anywhere, but, you know, in the regular course of trading, we're kind of strung out, right? And the same thing, a lot of people are trading August to December, that spread. And the same thing, you can see a lot of volatility. We're definitely in backwardation, and we're on the highs. And so there's a lot of signals out there in oil right now that are, even though there's, you know, a bullish forecast, some people suggesting $100, $275. We need to see some actual spot market movement that, you know, validates anything other than just kind of, you know, regular price action. All right. So finally, I kind of just want to look at, well, I don't know, finally, but the purple line is this 12-month calendar spread. So it's the prompt. So right now, July, right? And so it'd be July to next July. And then in August, it'll be August to next August, right? The 12-month rolling continuous spread. And you can see 2018, we were in backwardation. We've kind of slipped around. And the black line is month one futures, right? So just the prompt rolling continuous month one futures. And when we want to talk about a correlation, right? I like this correlation better than maybe like a US dollar correlation. Definitely sometimes the spread has to catch up. If flat price keeps moving and the spread is lagging, sometimes you can see the spread catch up. Sometimes the spread is the leading indicator, right? Like here, this calendar spread was rallying a lot more than flat price, and it eventually got flat price to move up, right? But now we're back in that range, right? Where we've been this kind of $5. So if we think about it, right, what could that mean? If we're not really bearish, but we're stalling up here, right? You can see a lot of signs that we're kind of reaching some questionable areas, right? Some pivot areas. Does that mean volatility will go down? If we're just going to trade sideways, maybe here, maybe we've reached a level, or are we, we're going to see huge testing of, will on both sides of this, and we might see it go way up. I feel like the summer could be low volatility. I know after oil prices collapsed from 100 down to 30, and then they kind of stabilized in the $60 level. It was like we traded $60 to $70 for a year. It was just back and forth, back and forth. So I don't know, if I'm seeing some signs of that, and I think implied vol has moved down a lot. The last thing, or one more thing I want to make sure I cover, is back to these spreads. There are a lot of options that trade. They're called calendar spread options. And so people buy or sell options on this spread. And last week, actually, on this August to September spread, the 50 cent, so it's currently trading 47 cents, the 50 cent call options, a market maker sold 10,000 of them at 22 cents. And you can see they are really protecting this 50 cent level in this spread successfully so far. They've kept it below 50 cents. But, I always look for what could be a pain point. You need something. You got to have something to, squeeze a short or move somebody, move the market to where somebody has to react. And, I could see if this spread started to really blow out, it could be exacerbated by some of these, it's been a while since I've seen calendar spread option position, like so aggressive. And so much size in a particular day. So, and they've also, they trade calendar spread options on all of these. And those are kind of like a nice lottery ticket, maybe, to have in the market. Does that, you guys are familiar with options, right? So calendar spread options are the same thing, right? Your strike price is just based on a spread versus the underlying. So, see, how do I wrap that up? Spreads, and more spreads. I would say, looking at the relationships for me, and the timing and the roles, the seasonality, those are things that, you can get a lot of good conviction around. You can put on a good position, and you can wait for it, to come to fruition. And you can have a stop. If you were to short one of these spreads, for example, right? Like if you went short right here, you want to get out maybe if it goes to 80 cents, right? Or maybe you don't really care, as long as it, what's it mostly going to go up 80 cents, and then, you're going to ride it back down. You risk 20 to make 60, right? On some of these. So it's a better risk reward in that way. And it allows you to hold your strategy into to realize it. You know, sometimes it's hard to realize a fixed, you know, an outright long or short because you can't tolerate the big moves, right? That come, so you chop yourself all day. And, you know, sometimes it's better to recenter and kind of get, you know, think of spreads as like the stability in your portfolio, right? They're the things that are going to bring you in some money every month. And then you can dabble in some of the more riskier types.
All right, thank you, Brynne, for that detailed presentation. We've learned quite a lot, new stuff. And maybe as we wind up, because of time, you can tell us if you still work as a market analyst at Cornerstone Futures.
I'm the director of research at Cornerstone Futures, correct?
Yeah, and how people can get in touch with you in case they're interested.
So you can either go, you know, I'm on Twitter, it's my name, Brynne Kelly. Or the cornerstoneGlobalCommodities.com. All of my research, I post a weekly detailed oil market analysis every Sunday. And if you want to go back and read any of the past ones, if you just go to that website and click on, you know, research and analysis, I think that's a really good place for people to start that just want to read. You know, I go into all of these charts. I try to pick them apart each week and talk about what relationship is important, or if there's proof through relationships of the current market sentiment. So I really recommend people going there and taking a look.
All right, thank you so much. And any book recommendations on oil? And of course, we'd love to have you again in the future. Your delivery is very simple for people to understand. So we thank you for that, and also for making the time.
Yeah, great. Yeah, it's early here, so I can do it before the day starts. I don't have a book recommend. I mean, I always tell everybody, go get Oil 101, the Morgan Downey wrote. It's, you know, but honestly, get yourself busy with the data. If you get your hands around the data and you just start playing with it, that's, you know, the best way to learn.
Oh, and on that point on getting busy with the data, Eugene wants to know whether you use FB Prophet library on Python to predict seasonality. I don't know what he means by predicting, but well,
I must not, because I don't know what it is either. I just, let's see, on the seasonal one that I did, I just simple averages, right? It's on Python, but just a 10-year and a 5-year. So, like, don't confuse me with a really good Python. I'm like figured it out on the fly.
Yeah, I think Eugene would be very interested to dig in. Seems like he's a programmer, and there are
excellent.
there are very many opportunities for programmers in this space.
Absolutely. That's why it's good for you to just play with the data on your own, right? Because you have a leg up then.
Yeah.
All right, Brynne, thank you so much for your time.
Thank you.
We'll see you next time. I'll link down the links to your website on the show notes and send you a link next week. Okay. All right, cheers, bye.
Have a great week, everyone.
Okay.
Thanks guys for tuning in and sticking with us to the end. We hope you have learned something new. I would like to appreciate Scope Markets for sponsoring this webinar. Remember, you can open a live trading account with Scope Markets and apply the lessons shared by the guest in this webinar to your trading. Many thanks to our guests for speaking to us. We'll be open to have you in the future. Till next time, goodbye.